We have a special guest today. You may have heard some of this while we were talking. I didn't realize we were broadcasting. There's a lot of interesting activity going on with real estate, and the asset class has always been a favorite of mine and family offices in general. There's very little you can say in general about family offices, but the asset class is one that is near and dear to many of us. There's a lot of unknowables going on simply because of office buildings and rentals and all that sort of thing. And I think that what we're going to learn today, part of which is that it's idiosyncratic to the old saying, a location, location, location. So having said that, please be sure that you help yourself and ask as many questions as you like in the chat box. You're so welcome to do that. Whether it's the Q&A or the chat box, we'll answer those questions as we go along here. And please don't be shy. We're going to record this. And so if you want to review it later or share it with others that are qualified, please feel free to do so. Lee and I have been acquainted just for a short time. It was apparent, as you know, I don't have any skin in the game here, but it was apparent right away that this what he's doing down there in the South, we love the South, is super interesting. And I wouldn't say that it's not affected by everything that's going on in the world, but perhaps less so. So we're going to learn a lot about that today, and then the unique nature of deal flow and how they buy real estate assets. So Lee, welcome, and thanks for being here. Take it away.
Arthur, thank you very much, and thanks to all of you for taking the time to dial in and listen to a little bit more about SharpVue Capital. I'm Lee Roberts. I'm here in Raleigh, North Carolina. I founded SharpVue 4.5 years ago. We're raising our second fund. Our first fund was about $72 million. We placed that in 11 investments across the Southeast, and we only invest in the Southeast. But within the Southeast, we're highly diversified. So we invest in any real estate product type and anywhere in the capital structure. And we think that's a competitive advantage. So I'm going to walk through a short presentation here, and I look forward to a discussion in which we can talk about real estate markets in the Southeast. Obviously, a lot of interesting dynamics underway. These are some of our assets that you see here. Again, highly diversified. And what we do as an investor is try to focus very much on a tactical bottoms-up strategy. So my favorite quote is from Sam Zell, legendary real estate investor, who likes to say, "We don't buy markets, we buy deals." And that's true for SharpVue Capital as well. The only top-down bet that we're making is that we believe that the Southeast will continue to outperform. I'll talk a little bit more about that, but it is very much a directly sourced off-market strategy where we're investing across the capital stack, across real estate product types, exclusively in the Southeast. I started the firm in 2016. As I say, the first fund was $72 million. We're showing a gross IRR for that fund of just over 16%, a 1.7 multiple. That's an unrealized IRR largely, but it is based on third-party appraisals, which we get at annual intervals for the portfolio. Our second fund, we're targeting 150 million. We've made 5 investments out of that fund so far. It has the same strategy as the first fund with the same return targets, 12 to 14% at the portfolio level. As I say, doing a little bit better than that so far on the first fund.
You're still on the same page. There you go.
So when we think about our competitive advantages, being local is an important part of it. So we like to think of ourselves as sharpshooters. We are plugged into the local markets in which we operate. When we hear about a deal, we know why we're hearing about it as opposed to somebody else hearing about it. We have a view on the product type. We have a view on the submarket. We're a small team. We are nimble and responsive. I like to tell our team that we're not on our 10th fund. We don't have $5 billion under management. So shame on us if we can't turn that into a natural competitive advantage and be more nimble and responsive than most of the other investors out there. And I think we've established, particularly for more sophisticated structures, a reputation for being able to structure relatively complicated deals relatively quickly. So we're investing either as limited partner investors, as straight common equity, as GP co-investors, which we've done in a number of our deals, as mezzanine lenders, as preferred equity investors, or as senior bridge lenders. And we've done each of those structures in any product type. We only find our own deals. So we're not competing on price. We think that the ability to invest across the capital stack is especially important if you are doing only off-market deals, because when you hear about a particular situation, it helps to be able to address a deal in whatever way you think provides the best risk-adjusted return. So we will sometimes hear about a deal where an investor is looking for common equity and will say, well, we can't do common equity, but here's a structure that could work for us and that we think could work for you. That's especially valuable in times like these, when markets are choppy and it's difficult to agree on valuation between buyers and sellers. Being able to put a more sophisticated structure in place can be very useful. And the markets that we're in are excellent markets. So the southeastern markets that we focus on have grown at twice the national average over the last 10 years. They're expected to continue to grow at twice the national average over the next 5 years, according to the Census Bureau. And these are extremely business-friendly markets from a tax and a regulatory standpoint. Not sure why my PowerPoint is taking, it's being bulky and advancing the pages here.
That's all right. We're good. Just take your time. It must be a little lag time. You're still on the same page. Competitive advantages. Yes.
I'll keep talking while I try to resolve the PowerPoint issue, for which I apologize. So across the Southeast, if you were to look at a map of our investments, you'd see a concentration in the Carolinas, because those are the markets that we know the best. But we have invested as far west as New Orleans and as far north as Walton, Kentucky, which is a submarket of Cincinnati. We don't go further than that. We're frequently asked about transactions in Texas, for example. And for a deal in Texas, we wouldn't know why we were seeing a particular deal there. We'd want to know why the guys in Texas weren't making that investment. And we frequently see in the Southeast, as these markets become more interesting, more attractive to investors from around the country and around the world, we frequently see investors come in and pay the wrong price for the wrong asset with the wrong partner in the wrong location. And we don't want to be that investor in some other market, which is what leads us to stay close to home, stay focused on markets that that we know and that we understand. I'm going to pull up the PowerPoint here in a different way just to try to make it more effective.
There you go.
You can see that screen.
Yep.
All right, I apologize for that.
That's okay. You can see it good enough.
Thank you. The hit rate that we have it's a very wide funnel at the top. Again, we're sourcing all of our own transactions. It doesn't necessarily mean that every deal we do had no broker involved. Sometimes we'll see a marketed transaction and we'll tell the broker what our own price is. That almost never is a successful way of getting a deal, but sometimes when deals fall apart, the broker will come back to us and say, if you're still good at that price, then we can transact at that number. And we do have a deal here in Raleigh where that strategy was effective. More commonly, it's just a word of mouth situation where our own personal networks are generating situations, and we're trying to make a rapid decision about whether it requires further work. So of these 328 investment opportunities analyzed, those aren't just deals that we heard about. That number is much larger, but 328 deals since inception that we've spent time on. We've built a financial model. We've done some level of analysis for the 16 investments that we've done so far, so just under a 5% hit rate. And we think that will continue. We're proud of the underwriting and due diligence that we do. I and everyone on our team have institutional backgrounds, and so we think we're applying a level of institutional sophistication, due diligence, underwriting, and structuring to a smaller average deal size. We put our investment memos and our financial models in our data room for any prospective investor because we're proud of the work that we do to underwrite every deal. We know it's more robust and more sophisticated than average investors at our deal size. We don't compete on price for deals. We never assume any cap rate compression. So the non-real estate equivalent of that is multiple expansion. We never assume that when we calculate our business plan for an asset, when we're underwriting the deal and looking at what we could sell an asset for in the future, we never assume that overall values will increase. The return has to come from our ability at the asset level to add value to the investment. We do very robust sensitivity analysis, always making sure that there's a margin of safety in every deal. And we focus on unlevered deal level returns in our underwriting, which is important in real estate because so many investors use significant additional debt to juice their returns while losing sight of the underlying asset level dynamics. That's especially true in circumstances like these when interest rates are so low. We also insist on control in a deal. So sometimes we do have partners in a deal. We'll sometimes partner with very large investors, but we always have the ability to do what we need to do to realize returns for our investors, to manage the asset, and most importantly, to sell when we believe it's time to exit.
Lee,
yes.
Can you just talk a little bit about unlevered? By definition, you're getting debt very likely on, it's not all equity, right? So what do you mean by not unlevered?
I mean that, so first of all, it's a mix in terms of our deals because in many cases we're an equity investor, but in many cases we're a lender. We're a mezzanine lender or a bridge lender. And so in that case, we're the debt. But you're right, when we're an equity investor, there is debt on a real estate asset, and that will improve the equity returns. But as an underwriting discipline, it's important from our perspective to make sure that the investment has an attractive unlevered return before adding in the calculation of the effect of the leverage. And I think that's especially important in real estate, where the levered returns can be significantly greater than the unlevered returns, and it can lead many investors to do deals that, in our view, are not necessarily as fundamentally sound. If you use as an underwriting discipline a focus on unlevered returns, and then whatever additional leverage you're able to add to the investment can enhance those returns, you have a much more sound underwriting process, in our view. It's especially true when the amount of leverage and the cost of that leverage and the timing of that leverage can be uncertain. And so it's just a good best practice, in our view, to focus on these unlevered returns when underwriting deals. The returns to the investors, of course, include the benefit of the leverage once that's added to the deal.
Gotcha. Thank you, Iva. Can you get closer to the mic, Lee?
Yes.
Or speak louder? You probably can't see the chat box, but someone suggested that it's a little.
I'll do both.
Okay.
And so I was also speaking about, while we do not invest in a top-down manner, where it's very much a bottoms-up, deal-by-deal strategy. The only top-down bet, as I say, that we're making is that the Southeast will continue to outperform. But I can identify some themes and some tactics that we've been able to deploy across the two funds that we've been, the first fund that we've fully invested and are now realizing, and the second fund that we're investing now. So bridge and mezz structures have been particularly interesting for us. There are relatively few players in the Southeast who know how to structure these deals at our deal sizes. So we're putting $5 to $15 million to work in a particular deal. That's our deal size range. And when you're talking about a convertible bridge loan, for example, and I'll talk about a specific deal in which we used that structure, the investors who know how to structure a convertible bridge loan are generally the larger debt funds who want to put $20, $25 million to work at a time. And the investors, the lenders who want to put a $5, $10, $15 million loan in place are the community banks, who have no idea how to structure a convertible bridge loan and wouldn't want to do it even if they could. They wouldn't want to they would not want to explain that to their regulators. And so being able to structure something more sophisticated like a convertible bridge loan in our deal size is a competitive advantage. And there's obviously a lot of capital chasing real estate across the board, but in the Southeast, there is a little bit of a gap in liquidity at that deal size, again, especially for the more sophisticated structures, because the friends and family capital, the kind of country club capital where you pass the hat for a particular deal, that caps out at $3 to $4 million. It's hard to raise more than that passing the hat for an individual real estate deal in the Southeast. But then the larger institutional investors who are increasingly parachuting into our markets, they want to invest $15, $20, $25 million per deal. So that inefficiency in the market is an advantage for us, again, especially when it comes to structures like bridge and mezz. Infill industrial is another interesting tactic that we've used. We have 3 deals that fit this description, one in Raleigh, one in Greenville, South Carolina, and one in Charlotte. This is older industrial product that's in very high demand. There's no new supply. In most cases, the supply is actually decreasing as these infill industrial assets get converted into microbreweries and loft apartments and artistic type office space, creative office space. But the demand is still there, and the tenants don't want to be in the modern industrial space out by the airports. They can't afford it. It's not where the location they want to be in anyway. They want to be near where their customers live and work. I'm talking about plumbing supply companies, electrical contractors, kitchen and bath suppliers. They still need the industrial space or flex space that these assets represent, but they can't afford the modern space, and the supply continues to diminish. So We've done a number of those investments, and they've been very attractive for us. Smaller markets within the Southeast can be very interesting to us. So I give the examples of Wilmington and Greensboro, North Carolina, Greenville, South Carolina. They each have their own dynamics. You have to know what you're doing. But as the rest of the world increasingly discovers markets like Charlotte and Raleigh and Charleston, you can find higher cap rates on acquisition and some interesting situations in some of these smaller markets that often have interesting and specialized growth drivers. And then I talked about innovative structuring and the ability to put a more sophisticated investment in place at a smaller deal size. In general, we've been avoiding land investments, multifamily investments, which are heavily oversupplied in most of our markets. We generally avoid new construction with some clear exceptions where there's something that protects against our downside risk, and we don't take open-ended lease-up risk in the average deal. And when you mentioned, yes,
I'm sorry. If you don't mind, can we address a question as
that'd
we
be great.
go? So we have a question that says, with regard to looking at unlevered returns, what's the IRR differential between levered and unlevered that you like to see? Recognizing that you say you don't do the analysis with levered, but what's the delta, right?
Yeah, well, we do the analysis both ways, but the deal has to stand on its own on an unlevered basis is the way I would say it. And it's a good question. So in many of our deals where we are a lender, there is no delta because we are the debt. If we're an equity investor, the answer really depends on the nature of the deal. And so we have got, as an example, an office and industrial asset here in Raleigh where the lead tenant, the tenant for all of the office space is the state of North Carolina. The state lottery is headquartered there. They have 7.5 years remaining on a 10-year lease. The state of North Carolina has a AAA credit rating from all three ratings agencies, and that lease covers 106% of the senior debt service. And so that asset can support a higher level of debt given the credit quality of the rent roll of the tenant base than, for example, a ground-up hotel development where the only ground-up hotel developments we've done in partnership with Hyatt, where Hyatt puts up half the equity and guarantees the debt. We've done 2 of those. But even with that downside risk protection from the Hyatt guarantee, it's important not to put too much leverage on a ground-up hotel development for obvious reasons. So a deal like that can support something like 60% leverage. A deal like the one with the North Carolina lottery as a tenant can support more like 80% leverage. And so depending on how much leverage you're putting on the asset, the difference between the levered and the unlevered returns will vary. And again, in many of our cases, we're the lender, and the difference between the levered and unlevered return is 0. So that's a long way of saying it varies widely.
That's good. Thanks.
So this is just a little bit more detail about our portfolio. And I mentioned the map and the fact that we have invested effectively across the Southeast. The brown boxes, the orange boxes are our first fund, and the green boxes are our second fund, which is open and which we're still raising, in which we are currently investing. And in talking a little bit, when I talk to investors, they're often quite interested in how the portfolio is holding up given the pandemic. And the answer for us is that it's holding up exceptionally well. I often say that I feel fortunate, and then my colleagues keep saying, I wish you'd stop saying that you feel fortunate, because we actually did do plenty of downside underwriting when we went into these deals. In other words, it's not it's not all luck, but we do feel fortunate at how the portfolio has performed. So we have only one asset that has any meaningful retail exposure, and that's the Progress Point asset that you see there in the middle on the right. It's in Wilmington, North Carolina, and the retailers there, it's at a very busy intersection in Wilmington. It's 75,000 cars a day. It's actually the busiest intersection east of Raleigh in the state. And so the tenants are a nail salon, a hair salon, a burger place, a donut place, tenants like that, who in large part had been shut down as a result of the pandemic, but all of whom are now back open and are current on their rent. So we get a rent report at the 10-day mark and the 20-day mark for each month. And the 20-day report is useless because every tenant is current on their rent by day 10. And that's been true throughout the pandemic. The thing to watch for there is whether any of these tenants are using PPP funds to pay their rent, and whether the PPP money runs out before their business recovers. But given that all those tenants are back open, we don't think that will happen. And given the leasing history in this asset, which is very strong, it was built in 2002, it stayed fully leased throughout the global financial crisis, which hit Wilmington very hard. If we did lose a tenant, if we did lose a nail salon, we'd be able to backfill them very quickly. Charlotte Commerce Center, which you see in the middle there on the left, and Charlotte obviously is exactly this kind of infill industrial asset that I mentioned earlier. It's got 57 tenants. It's an older flex building, light industrial building, and for the monthly rent, 56 of the 57 tenants are current on their rent. We did have one tenant renege on their lease. I don't know if you all are familiar with this escape room concept. That didn't fare very well in the pandemic. So we've got one tenant who is delinquent on their rent and will be vacating, but the rent performance of that asset is actually better than normal. So we normally, with 57 tenants, you normally have 3 or 4 who are in transition, having payment problems, moving out. And so that's performing better than we would normally expect. We have 4 operating hotels. You see them here on the map: the Airport DoubleTree in New Orleans, the Aloft in Tampa, the Hampton Inn in Volano Beach, Florida, outside of St. Augustine, and the Hyatt House, which if you look in the upper left is in Nashville, Tennessee. So hotels have obviously had a rough ride in general. Limited service, which is what we have, has generally done better. I was on a call with Barry Sternlicht, the founder of Starwood, legendary hotel investor, a little while ago, big industry conversation. And Sternlicht said, look, I have probably developed more hotel rooms in New York than anybody else over the last 20 years. And I would much rather have a hotel in Myrtle Beach, South Carolina than in New York City right now. And those are the kinds of hotels we have, the Myrtle Beach type of hotels. Volano Beach, our Hampton Inn there, again, is doing better than it would normally be doing this time of year. It's been running at about 80% occupancy, given that the beaches have been open in Florida, but the theme parks have been closed. Our DoubleTree at the New Orleans Airport is largely supported by long-term corporate contracts. So some to the airlines, cargo and passenger airlines, but many more to oil service companies who are moving crews in and out of rigs in the Gulf. They've continued to use their rooms. They didn't use them in the month of March when oil prices collapsed, but they've been using them since then. Our Hyatt House in Nashville, I was just there last week, and that hotel is within 3 blocks of 3 hospitals. It's in the west end of Nashville. There are no COVID patients in the hotel, but there are patients who are there for non-emergency surgery. There are lots of families staying there, and there are a lot of employees of the hospital staying there, particularly nursing staff who have long commutes and are doing extra shifts. We have corporate contracts with the hospitals to to put them up at our hotel. We have 4 development deals in the portfolio, and early on in the pandemic, there were some delays created by not being able to get inspectors to sites in a timely way. But every municipality I'm aware of, certainly all the ones that we're in, have worked those delays out. Construction is a critical industry in every jurisdiction. Every now and then we will have a specialty subcontractor have a problem with a particular crew member. And then their crew will have to go home for the rest of the day. So you might have a specialty lighting contractor lose a day, but in total, those delays don't add up to any more than weather delays. No material, no impact to the overall timetable for any of our construction projects. So we do feel very fortunate about how the portfolio is holding up through the pandemic. We do think it speaks to the quality of our underwriting, and in particular to our focus on downside protection. I wanted to talk about a couple of deals that we have. I'll pause before I do that and see if there are any questions on what I just went through.
We do, Lee, have a question here. How are you forecasting the PPP economic stimulus phase out in return to normalcy?
It's a good question. So for forecasting purposes, we have been assuming that the PPP does not get extended and our existing tenants have no additional support. And so if they are not open now and can't operate at a profitable level, we've been assuming that they can't pay their rent. Fortunately, we don't have any tenants in that situation. In North Carolina, an example would be a gym or a movie theater. In South Carolina, even those are open. In Georgia, even those are open. We just don't have very many retail tenants, and the ones we have are open. And the industrial tenants that we have, of whom we have quite a few, they are open and operating. And so it's just not really an issue for us on average across our portfolio. I would also mention, I'd be happy to talk a little bit more about my own background. I've spent my career in real estate, finance, and investment. But immediately before forming SharpVue, I did a brief stint in public service, during which I served as budget director for the state of North Carolina under the previous governor. And I now teach a class in public budgeting to public policy graduate students at Duke. And I mention that because I follow public budgeting issues very closely, including the PPP and the CARES Act and the stimulus package overall. It does seem clear that there will be a deal on PPP for extension, but again, that's not factored into our assumptions.
Super interesting. I did read that, by the way. We didn't talk about it. Lee, it's not germane to that question, and Rob Colorina, thank you for asking it. It is helpful usually for a variety of reasons to get a sense of how many LPs were in the first fund and how many in the second so far and how many you expect, just to get a sense of the number of checks that you've taken in.
So in the first fund, we have one institutional investor as our lead investor, Southeastern Insurance Company, and we have one other institutional investor in that fund, a university endowment, and everybody else is family office and high net worth. And the average check size is misleading because the range is very great. So we have 129 investors in that fund, and that tells you that there are some smaller high net worth investors. In the second fund, so far we have the same institutional lead investor, and again, the rest of our investors are family offices and high net worth, and we have about 35 investors in that fund, of whom I would characterize 8 to 10 or 12 as true family offices, and the rest is high net worth, including some fairly high net worth investors, but not really true family offices.
Great, that's helpful. Thank you.
I realize there's a lot on this slide, and I'm not going to go through it all, but I think it's an interesting deal for two reasons. One is that it shows our ability to invest through the capital structure as a deal meets development milestones and is de-risked. And secondly, there was just a realization for this deal. It was just recapitalized by a large international institutional investor just a week ago. And I think it's a good story from that standpoint as well, just as a sign of what's happening in real estate markets, at least in the Southeast. And so this was a deal that we went into in the summer of 2016. The borrower was a development joint venture. They had a site under control, this historic mill in the Optimist Park neighborhood of Charlotte. And they needed a loan to acquire the site and do the pre-development work. They didn't have any tenants. They didn't even have the site acquired, and so they weren't really eligible for a traditional senior construction loan. But we liked the site. The light rail was scheduled to run along the back of the site and does now, but it was not operational at the time. The Greenway network was scheduled to be extended to the front of the site, but at the time had not been. And the whole area, while beginning to transition, was still transitioning for sure. It's the kind of neighborhood where you wouldn't necessarily have left your car parked there overnight when we first went into this deal. And we put in a 50% loan to value convertible bridge loan. So day one loan to value was 50%. Those loans mean that the loan to value decreases as the developer acquires the site and does their pre-development work, because the value of the site increases. And the convertible bridge loan was convertible to mezz at our option once the our borrowers were eligible for a traditional senior construction loan. From a downside underwriting perspective, if they had never added any value to the site and just handed us back the keys, we would have owned this site at 50% of the value for which it had just transacted. And when you own a site at 50% of market value, you can hold on for a long time and still deliver adequate returns. That's not what happened. They developed the site. They did their pre-development work successfully. They began the build out of this old historic mill, which is a combination of 91,000 of office and 50,000 of retail, the retail being mostly food hall. And the office space, given that this was a transitional neighborhood, given that the light rail was not yet running, given that it's an old mill with this exposed brick and beam loft type office space, we thought the tenants would be local creative class type tenants, design firms, advertising firms, little local firms. Instead, Duke Energy comes in and signs a lease for all 91,000 feet of the office space, an 11-year lease with 3 5-year extensions. So it worked out very well for us, but an interesting sign of the times in the office market as well, where a tenant like Duke, traditionally the most kind of blue chip conservative tenant, would move into a more transitional neighborhood like this, into this kind of product, this old mill redevelopment type of office space. And what the Duke people were saying was that it's hard enough for them to attract and retain young people. This is an IT function that they've moved there. Very difficult to attract and retain young IT professionals. They don't want to work for a big company. They really don't want to work for the power utility. But one of the few tools, therefore, that a company like Duke has is to put them in some office space that has some kind of cool factor to it. And so once the Duke lease was signed, the deal was significantly de-risked. The developers were eligible for a senior construction loan. We converted our bridge to mezz. Given the credit quality of the tenant, we added an additional slug of preferred equity to finance the build out for Duke, and the entire asset was just recapitalized by Jamestown, which, as some of you I'm sure know, is a German investor with a large U.S. presence based in Atlanta. It wasn't that long ago that an investor like Jamestown, and Jamestown in particular, wasn't that sure that they wanted to be in Charlotte. They were very much focused on large gateway global markets, and it was something new for them to go into a market like Charlotte. And on either side of this mill, where there used to be abandoned, boarded up houses, there are now multifamily projects being led by large national multifamily developers. And so for an investor like Jamestown to come into a neighborhood like this in Charlotte in the middle of a pandemic, we think is an important sign of health for Southeastern real estate markets. It obviously worked out very well for us, but it's an important sign of health for, we believe, for markets generally. And we are seeing that in other deals as well. In some cases, especially if the buyer obviously has a very long-term perspective, paying pre-pandemic pricing and figuring that however long the pandemic lasts, these assets will be worth owning and will cash flow strongly over the longer term. We also believe, as Arthur alluded to at the beginning, that in many ways the Southeast is benefiting from the pandemic. Obviously, the pandemic affects everybody in negative ways, but to the extent that there are both individuals and families and businesses that have thought about leaving the higher cost Northeastern and upper Midwestern markets at some point and moving to lower cost Southeastern markets, maybe idly thinking about it, maybe the pandemic has meant that someday is sooner than they thought. We certainly see that in the residential real estate markets. Residential real estate brokers in the Southeast are having record years. They kept waiting for their record spring selling season to tail off as we moved into the summer, and it hasn't. And many people buying houses sight unseen, coming from Northeastern markets. And when you talk to the economic development folks for North Carolina, South Carolina, Georgia, Tennessee, they've never been busier. A lot of inbound interest in these markets, which obviously from SharpVue's perspective works to our advantage over time.
Super interesting. Anecdotally, I've seen people buying things in just people I know sight unseen and competing at Market Plus in Florida and the Southeast and so forth. I don't need to get into the weeds, but the print is a little too small for my aged eyes.
Yeah,
but
sorry.
I'm just doing the math in my head. If you went in at 50% LTV at 10, you picked up a valuation from 50 to 71 just in that conversion.
Well, 72. That was the 12/31 appraisal. It was actually the price that Jamestown paid. So it's really the difference between what the asset was worth when we first went in and what it sold for. Yeah. So the conversion happened during that time.
Yeah, nice bump.
Very much so.
Yeah.
Especially given that we were in a secured position the entire time. So we were never at risk as a common equity investor in this deal. And we wouldn't have gone in as anything other than a secured bridge lender when we first began talking to the borrowers. And it reflects what I was saying earlier about the importance of being able to operate across the capital structure. So if all you can do is common equity, or for that matter, all you can do is mezz, then there are many fewer deals that you're able to address. And for this deal in particular, neither mezz nor common equity would have been appropriate for the situation, for the cost of our capital and our perception of the risk when we first went into the deal. But knowing how to structure a convertible bridge loan made all the difference to our ability to be constructive here.
Yeah, and the counterparty that ultimately you're dealing with is super great.
Indeed.
Yeah, very cool.
I was going to mention one other deal. I'm happy to talk about any of our deals, but one other that I thought was interesting. It's here in Raleigh, and this is the deal I mentioned where the lottery is headquartered in the space, and so that's this Capitol Boulevard deal. And the reason I like to bring it up, first of all, it's an example of us finding a deal where there was a marketing effort in place, but we paid the price we thought the asset was worth. So this is an office and industrial asset. The office, as I mentioned, is fully leased to the state of North Carolina. The industrial space is this light industrial flex type space with a lot of smaller building supply, plumbing supply, electrical contractor type of tenants. The seller had it on the market for in the fall of 2017. They had it under contract at $42 million. We were following the process. We didn't bid because we don't bid on competitive deals, but their buyer who they had under contract at 42 million fell out, couldn't perform. And we went to the seller and the seller's broker and said, we know you wanted to get this done by the end of the year. If you still want to sell by the end of the year, we can perform. Our price isn't $42 million, it's $27 million, but we can get it done by the end of the year if that's important to you. And so we were able to put it under contract at our number, the number we thought was justified, following a broken bid process. We actually didn't close by year end through no fault of our own. We went through a series of contract extensions. We now have $30.5 million in the deal, given some money we've spent on upgrading the space. But it's a good example not only of being opportunistic and finding deals, but in how we underwrite transactions. So we like to make sure that there is a really solid base case, that there is an upside potential beyond the base case, and that the downside is very well protected. And so in this case, the downside protection comes from the state of North Carolina lease, the 7.5 years left for the lottery's lease, AAA tenant covering 106% of the senior debt service. The base case comes from leasing up the vacant space in the building and increasing rents, which we've done. And I mentioned earlier the value add light industrial, infill industrial play. In many cases, these assets are have average rent levels below market, and you can add a lot of value simply by raising rents to market levels. And the tenants often say, "That's outrageous. I'm not paying that." And they come back 2 weeks later and say, "Where do I sign?" Because there's so little of this supply in the market. We can often, what we did at this project and what we've done other places, is often move them to a smaller footprint. Many of these tenants don't need as much space as they have. And so we can move them to a smaller footprint, raise their rent, but keep their out-of-pocket cost, which is what you really care about as a small business person. They keep their out-of-pocket cost flat or even lower, but we've improved the rent roll of the building. We've created additional leasable space, and we've improved our average rents. And so that's what we've done here. The upside case is that this is on 32 acres of land at the intersection of US 1 and the 440 Beltline in Raleigh. It's the busiest artery that's not an interstate highway in Raleigh. It's a prime location. And we didn't really pay for the excess land. We bought this asset off a cap rate basis. That was our underwriting. So we really got this excess land for free. And the upside case, which may or may not happen in our hold period, would be to redevelop this excess land. And so I bring this up as an example of how every deal has got a downside protection case, a base case that delivers the appropriate risk-adjusted returns for a given investment, and then an upside case where if we get lucky, there are significant additional returns available. And we do this we run a lot of cases, a lot more than 3. But these are the 3 that we always make sure that we have. And when we test the downside case, we always look at, suppose we were investing in the summer of 2008, and what happened to these markets, to this product type, to rent levels in this location, to interest rates, to leverage levels, to cap rates for a deal like this in the summer of 2008 and in the years that followed. And if it did turn out in retrospect that we were investing in the summer of 2008, could we still deliver an adequate return to our investors, even in that deep downside scenario? And unless the answer to that is yes, we move on. That deal falls in that 95% bucket of the deals that we analyze and that we don't do. So I bring it up just as an example of our underwriting and an ability to create a deal where and pay our own price in a broken transactional process.
Super helpful. Would you mind, Lee, if I got one more question in here from our friend Rob Colorina?
I see it about the non-North Carolina participation.
Yeah.
Yes. So there is certainly a concentration. We certainly have more investors from the Carolinas than from any other location, but we have investors from around the Southeast and around the country. More so in the second fund than in the first fund. When you start off, you tend to do best with the folks who you know already. But what I think the non-Southeastern investors have really liked about the strategy is that most people, I rarely have to explain in a presentation, even to international investors, the Southeastern growth story. Most investors have heard about the U.S. Southeast and they believe in the growth. And so then the question is, how do you get exposure to it? And there are a lot of institutional investors playing in these markets. The number of investors out of DC or Chicago or New York who have put acquisition people on the ground in markets like Charlotte and Raleigh and Charleston is remarkable, and many more are just flying in, once a month. But if you want the exposure to the Southeastern markets, I would argue that the best way to get it is through a team that is already on the ground, is already networked, is already plugged in, is already doing off-market deals in the region, rather than allocating to an investor, whether they're truly parachuting in or whether they've put someone on the ground and told them to go out and find deals. We are going to find better deals. We're going to find them first, and they're going to be underwritten better because we're already in the region and in the market. And I think that's been compelling to investors from all over.
Thanks for that, Lee. Thank you, Robert. Rob. We're running up against time here, and I'll admit that this is a question that I'm super interested in knowing the answer to, and I think others are. The preponderance of the people on this call are likely to be taxpayers. What's the K1 look like in the first fund?
You mean just the timing of the K1 or the tax drag?
Like the net impact. Like, have you been able to capture depreciation, pass it through? Is there a coupon that you're paying on a pref? Is there what's the taxable impact? Am I paying ordinary income on part of it? Am I just taking gains? How have you structured that?
Yeah, so most of our investors are taxable, including our anchor investor. We're not one of these funds that's anchored by a non-taxable investor and therefore isn't sensitive to tax. We're all highly sensitive to it. We do pay a current return because most of our assets are either they're cash flowing, in which case we receive rental income, or we're in a secured position, in which case we get paid interest income. For an asset like this one, the Capitol Boulevard asset, even though it's cash flowing for a period of time, we redeployed some of the rental income into improving the building and getting the vacant space ready to lease up. But that's now become cash flowing. And so the yield in the first fund on the portfolio annualized is right around 4% for 2020, with the difference between that and our target being capital gains when we sell or refinance an asset. The yield will be a little bit lower at the beginning of a fund for the reason I just said. We tend to be reinvesting rental income in deals, but we do pay the small current return, and we pay it quarterly. We're a limited partnership, so all the depreciation passes straight through.
Great. I think that's super helpful because it's good to be a taxpayer in the United States, turns out.
Yeah.
And the insurance company clearly is a taxpayer, right?
That's right.
Yeah. Lee, we have to wrap it up. I don't see any further questions. If anybody has any, please go ahead and send them over now. And we'll be following up and connecting you with Lee directly. And Lee will have your information. And of course, this will be recorded. You want to have a few closing thoughts and let people know how to send you money?
Well, Arthur, thank you very much. And thanks to all of you for taking the time to listen to a little bit of our story. Our existing portfolio is holding up very well. We're seeing great opportunities born not only of the inherent growth story in the Southeast, and born not only of our ability to source and execute off-market deals, but also born of the pandemic conditions themselves. So we did one deal in the second quarter, which was a true distress recapitalization born of the pandemic. We're looking at a few more now. We're not paying pre-pandemic pricing for assets. And again, I think it speaks to the value of having your ear to the ground and being very networked locally. And we are raising our second fund, as I mentioned. Our contact information is in the email. We have a full data room with all of our investment memos, all of our financial models. Obviously, the presentation that I went through, our private placement memo. We've completed a full institutional due diligence questionnaire, so I'm confident that any information that you might need that would be helpful to you, we can make readily available. So thank you very much again for your time and your interest.
Thank you, Lee. That was super helpful. Really enjoyed it. Did a nice job of picking the good examples. And thank you, all our friends and Family Office Insights, and you've all been awesome through this time. And as you may know, I'm jet setting around the country in not a jet. And so dutifully out of New York City for a while, but going back as soon as I can. So thank you, Lee, again, and thank you, everybody, for being on the call. We'll make sure everybody is connected with each other until next time. Thanks very much.
Okay. Thank you very much.
Bye-bye.